Well, hi everyone and welcome to the InvestSMART International Equities Portfolio webinar. We're live today actually from the Melbourne office.
Sitting next to you, Tom. It's so strange to be sitting here to actually talk to you. It's really good to actually be in the room and finally sort of getting back to post-COVID normal.
Yeah, slowly but surely. And so I'm Tom Wilson. I'm one of the product specialists at InvestSMART, and I'm joined literally in person by Evan Lucas, our Chief Market Strategist.
So yeah, it's good to be here. Good to see you, Tom. We're going to go through quite a lot today because I know there is a lot of questions. We're really excited, obviously, too. There's a lot of you online. There's over 100, which is really nice to see. So we're going to quickly run through the portfolio, very just nuts and bolts basics. And then we want to jump into your questions because I can already see lighting up on Tom's computer the questions. And we really do want to go through that because we do not want to sugarcoat in any way what's going on right now. Markets are volatile. Things are really rough. There's no doubt about that. What we're trying to talk to you about today is to reorientate your thinking, reorientate your timeline, because again, that's the other part of this is trying to think in a continuum, trying to think about the longer term issues and therefore think about the longer term opportunities that come with it. So going through the international portfolio, if we have a look, why we've called this why just a 1% different matters, that is basically roughly over the last 10 to 15 years, the difference between an international investment versus a domestic investment. The other thing that we know also from a domestic perspective is that the latest ASX survey that came out in 2020, so it's a little bit old, the next one unfortunately comes out in about a month's time because it comes out every 2 years, shows that Aussies still are incredibly underinvested in the international equity space. Thankfully, from the last survey back in 2018 to 2020 and going back to 2014 to 2020, the amount of people holding international equities has gone from about 1 in every 10 investors to about 1 in every 4, which is good. However, when you look at those 4 investors, the allocation in their portfolio to international equities is about 2%. So yes, you're invested in it, which is great, but your holdings in it are way too small. So that's part and parcel why we invented this portfolio, is to give you, again, what we always try and do here is a complete, smoothed out approach, that there isn't any stock picking or anything like that. It's more about giving you international equities done by the weightings that they are geopolitically, so the US being the biggest and then scaling down from there, all those kinds of things. So going to the next slide and having a look at that.
Should I just point out too that, of course, it's general product advice only, personal financial advice. Ask questions. We've got a stock of questions, as Ev's already mentioned, but on the right-hand side, you can pop a question as we go. The theme definitely so far has been a lot of questions about the foreign currency. We'll definitely be touching on that.
Definitely get to that.
The portfolios, we'll be touching on that. How do you get into it yourself, whether you're a brand new investor or if you're someone who's already invested? I'll show things like that myself. But we'll also jump to the next slide and make it a bit easier.
So this answers already that question that Tom was just talking about in terms of the holdings. So here is the breakdown by weightings. Having a look at VGS and IVV, they're the 2 largest holdings, and let's go through them very quickly. VGS is Vanguard's global stock ETF. It is, as I said, done by scale in the fact that it goes, the largest equity market on the planet is the US. About 60% of the portfolio is in the US. Then it jumps to Japan, then goes to the UK, France, Germany, scaling down across the 22 of the 23 MSCI developed markets. Now, the 23rd, the one that's missing, is us, for obvious reasons. This is an international portfolio. We don't want Australia in it because you've already got it. So the VGS is an absolute scaled version of global investments. What we also know and what we also do is that we do follow peers, as we do with all of our diversified portfolios and all of our single portfolios, to work out where they're weighted. And we basically try and make sure that we give you an international portfolio that matches the weighting of the consensus of the market of what they believe is an international portfolio. So that's why IVV, I want to raise that as well, because IVV is BlackRock's S&P 500 ETF that they offer globally. So it's the same ticker code in the US. They offer it here, thankfully, in Australia, traded on the ASX between 10 and 4 every day. In Aussie dollar terms, it's a complete replica of the S&P 500 ETF they offer over there. It's a beautiful product. And why it's 37% of the portfolio, so that we make sure we give you the right exposure to the US, like the peers do across the board. It's also in there. VEQ is our European offering. Again, it's to making sure that the weightings there are correct. IAA, that is the A50, so that's the China A50. It is obviously quite an emerging part of the market in where it is. We believe it's there. It's definitely what we are knowing and seeing competitors doing as well. So that's why it's in there at the moment. It's only 6% of the portfolio. The UMAX, that is actually basically the US market dividend optimizer. It's about to give you some return. We know you love your dividends, so we made sure that we also have that in there. So there's a 3% offering to the higher level dividend returns. Being aware, Australia is the highest dividend paying market in the MSCI world. So it's a bit not as counterintuitive. We're not trying to give you dividends in the international portfolio because international equities tend to not do that. That's something we do in this country rather than over there. And then finally cash. So that's the breakdown. We're always very transparent about that. You can see that on the website. Tom will show that later. Just do it now.
I'll just duck there now, just so you can actually see where it lives on the website. And a lot of those acronyms that everyone was throwing around in terms of the ticker code, it makes it a little bit easier on the website too. So I'll just jump to my page, and on the InvestSMART website at the very top, if you go to investment portfolios, you'll see it sitting under single asset class on the right. So I'll click this. It takes us to this web page. Obviously explains some very important detail there, but if you go down just a bit further after the chart, key facts, asset allocation, holding, and it's showing you a much overview here in terms of it's 99% international equities, and Evan's just showing you the breakdown inside. But on the right hand side here under current holdings, you'll see all the ETFs that Evan has spoken about. And there was a lot of questions about what's actually inside these ETFs.
Yeah.
You can Google
Google
ticker codes.
Yep. And look, let's just quickly run through them. I mean, one of the questions I know that came through is, how do you diversify across them? What are the 500 that are in there? And I'm pretty sure that came through from John. So I'll answer that now. Let's take IBV. That is the complete replica of the S&P 500. So like if you are invested in a diversified portfolio here, or something like IOZ, which is the Australian ETF, it is the top 500 companies in the States, weighted accordingly to their market cap size on the S&P 500 over in New York, running down accordingly. So you're obviously going to have your Microsofts, you're going to have your Apples, you're going to have also, across the board, your MasterCards, your Visas, the banks that are over there, JP Morgan, Goldman Sachs, take your pick. Across their whole space, you then move into places like Pfizer, which are also listed over there. All of those companies are in that. And again, the weighting in terms of what they are exactly the same makeup as the S&P 500. So that's the way to look at it. If you then look at something like VGS, which is another good one to look at. Again, if you go into Vanguard, they'll tell you, but I can tell you right now, as I said, they go, right, we need 63% to the US. Again, the weightings are run down accordingly in terms of the individual equities to the weightings that are there. So again, Microsoft, Apple, blah, blah, blah. To the UK, it then goes the FTSE 100 and goes, right, the top holding in the UK is Vodafone and Unilever and GlaxoSmithKline. They're all in there as well. Goes across the ditch and into places like France. So you then have the CAC and what the top listings there. So EDA, you then have all those kinds of things into the DAX, and you've got the 30 offerings in the DAX. So you've got the car makers, Daimler, BMW, Volkswagen. You then go and look at AG InBev with their, so all of that you have exposure to in terms of that international portfolio, if you want to go to that granular level of understanding the shares that are in there. But those ETFs, the way that they work is, again, they go, let's take the EVQ as an example. It looks at the stock 600, goes, okay, which are the top 600 stocks, and it then awaits it accordingly. So again, we're not stock picking here. We've always told you that with these portfolios. That's not what these portfolios are for. This is designed to give you international exposure weighted correctly to the market capitalization of the individual markets that we're in, so that you actually have that opportunity.
Yeah, it's a very good point, because I often get asked when I talk to a lot of clients out there, can I just do this myself? And you could go and buy a Vanguard ETF like the one we hold there, but the beauty of what we do is that we manage it for you. It's a professionally managed account. We give you international exposure, not just US exposure, but we handle all the different overseas markets for you.
So if we go back to our presentation and on that point, so why we talk about this and why international equities, as I said at the start of this presentation matters, is that on average, over the last 30 years, it returns to about 10%, give or take. Now, again, if you take different time points, I'll be wrong on that, but let's just go on the idea that the average has been 10%. The ASX has averaged about 9%. And why I've done that is it was one of the questions and quite strongly came through in your pre-webinar questions about why would I invest internationally? It's only a 1% difference. That 1% matters like no tomorrow. And why I've shown this chart here, I understand it's very smooth and it does show things, you know, looking quite neat and tidy. That's because markets never actually give their average. I mean, I'll give you an example again with the ASX. The ASX, that 9%, that's what it's averaged over the last 15 years. And I can actually tell you now that in the last 15 years, it has never once given you 9%. The closest it got was in 2016, which was 11, because it either has a really big up year like last year where it was 20%, or a decline like we've got this year, all in between. But if you smooth it out, and that's what this chart does, the smoothing out shows you this, that 1% compound difference, and it is total returns that I've done here, shows that after 30 years, if you started with 10 grand, reinvested everything you did, and that was the way you went about your business with regards to your investing, the difference would be about 41,000. So you can see here, you've come in with about 174 grand in the international holding, and if you held just the Aussie market, you'd be coming in at about 139. So we still needed exposure to the Australian market. We're not saying any difference. What we're showing and what we want to tell you here is that being underinvested in international equities can actually be detrimental to your long-term performance and your long-term return. We'll keep moving through because the questions are coming thick and fast, and I really want to get to them. So this is the portfolio's performance over the since inception. Do want to again, we do not sugarcoat anything here. Do want to clearly point out that between 2015 and 2018, we actually had this actively managed by an external company. They weren't doing very well, so we took it back. And this is now run exactly as we've always talked about with our passive run, the way our mandates are. All the holdings are highly liquid. They are as close to we can get to being the cheapest with regards to the management expense ratio. We also make sure that the price of them is at a point that is easy to make sure that they can diversify to those levels that we saw in the weightings, and also that they're highly, you know, correlated to the exchange they're in. So they're the 4 criteria. And since we've gone back to that, you can see that the portfolio is performing exactly as it should. And it has not only got back up to peers, we are now ahead of peers, which is what's really important. So the chart at the bottom, the table, shows that basically since we took back ownership from 3 years on, we have been outperforming peers with a passive mandate, not with an active mandate, with a passive mandate. So we're really, really happy with it. We know that you love it, and that's why we continue to offer it to you and why we're doing these presentations on a regular basis. That's the nuts and bolts. That's the nuts and bolts. I'll let Tom very quickly just take you through just the sort of the fees and charges, because then let's jump into your question. So why Tom brings that up, as you said, on the right-hand side of your dashboard, have a look. There's a question set, jump in there, and we'll get onto them after Tom just goes and quickly runs through the fees and charges.
Yep, no worries. So as we mentioned, it's part of the professionally managed account. So what you do is you open up a professionally managed account with InvestSMART, and we manage it for you. That's the PM part of the acronym. Basically what happens then is we go out and we purchase the holdings, the ones that Evan's gone through, and we make sure that they stay within their ranges. The fee that we charge for that is 0.55% per year, and that's from a $10,000 minimum. So if you open up an account, just choose international equities, it's 0.55%.
And caps out.
And it caps out. So this is one of the things that we do that no one else that we know of in our industry does this, and we cap our fees. So as soon as you have more than $100,000 invested, the fee stops growing. So you could have the international equities, you could have some of the balanced portfolio if you wanted.
Yep. You could have the property and infrastructure portfolio. You could have any of match and mix and match. The total value of those portfolios, or the one portfolio, or however you've done it, that is where we take it from. So if you've got 25 grand in 4 different portfolios, that's your 100, and that's where your cap stops. So it's not 25 grand, 0.55, 25 grand, 0.55. It caps out. We are not looking to get you on fees. We are trying to be as transparent as possible and give you the opportunity to get invested the way that you want it as cheaply as we possibly can.
That's it. And yeah, basically the way in which we try and beat our peers is keeping that fee very low and capped, so that money stays in your pocket. As we've seen with that benefit of compounding return, it helps grow much quicker.
Actually, we'll finish there. I'm going to bring straight on to this point because we got a question from Duncan. So absolutely no underlying fees at all was his question. So let's sort of expand on that, because again, our fee we've just discussed, which is the administration fee, which caps out at $100,000, which is $550 total per annum. However, there are some other little fees that are included. It is, as Tom is showing you here on side of it. Don't forget, all ETFs have a management expense ratio. So that is actually in their inside their fee. So if I take something like IVV, for example, the cost of that per annum is what we call 4 basis points. That's what BlackRock charges. We don't actually touch that. It's BlackRock. And that is basically 0.04 of 1% of your investment per annum. And you'll never really see that because the way they do it is they put it in the price. So the spread of that price changes ever so slightly to incorporate that fee. It's the same with all those ETFs. They all have that slight fee inside it.
Yeah. Basically, they all want their pound of flesh.
They all want their pound of flesh. But again, it's what we try, and what part of the 4 mandates that I said before, we try and give you the cheapest one we can get. So it is one of our core findings is that we try and find a management expense ratio that is as low as possible. So if there's 2 that are comparable that are exactly the same, so let's say it's one from BlackRock and one from Vanguard, let's say that BlackRock is cheaper, we'll choose that. Because they're doing exactly the same thing, but the cheaper opportunity is what we will chase.
And we still make sure it's obviously liquid. We can trade it very easily, buy and sell it. With those ETFs, you can hold them yourself, or if you decide to go through us, you'll still pay that fee. It's something that it's not something that we charge. The only other fee is because we are literally opening up a brokerage account. We'll buy you these holdings, these ETFs, and they'll be in the name, your legal owner of the actual ETFs. So we pay brokerage. We've got institutional pricing for that, and that's $5.50 per trade, or 0.99%. I actually think it's come down since then.
It has.
So slightly. Up that page.
So it's actually, I think it's down to $4.95.
$4.95, which very, very.
So again, that's part and parcel of what we do here in InvestSMART with these passive investments, is that we are always tracing the lowest possible fees for you. That's absolutely core to everything that we think about. It's almost the front in mind of where we are. The more cost effective we can be for you, the more we know the returns. I mean, going back to that chart I showed you about the 1% difference, that's exactly the same principle applies to your fees. The more fees you pay, the less return you get. Therefore, the compound issue of that over time comes to the fore. So that is why, front and center, we are standing there with that. So with that, let's jump into questions. Let's go with who's online before we jump into the pre-questions.
Yeah, excellent. There's the talk about the foreign exchange, which is quite a heavy
should we jump into that? Let's do that, because there must be at least 10 questions that we got before it, and there's at least 3 questions I can see. So let's talk through the exchange rate. Right now, I'm sure you're fully aware that the Australian dollar is falling back to the level we haven't seen since the start of COVID. So it is at a 29-month low. It's currently at about 65 US cents as we talk. What I want to point out though is this, that difference between the currency, leaving it unhedged, has pros and cons. We know that. So if you look at it right now, if you look at buying into US dollars, it's obviously expensive. We understand that. But on the flip side, when it flips around, it goes the other way. What we've also seen over time is that the cost of actually hedging, and what we mean by hedging, trying to take out the currency fluctuations, the cost of that over the long term is actually detrimental. So we review this constantly. It gets again back to, there are ETFs out there that have a hedging component built into them. They are certainly very much part and parcel with what we look at all the time. But for example, to look at something like IVV, which is a great one, and then look at the hedging version, the MER on the IVV, as I said before, is 0.04 of 1% or 0.09 of 1%. But I do know that the hedging one is near enough to 0.9. So you're talking about 90 basis points difference, and that is huge in terms of an expense. The impact on your returns is large. The next thing I also need to point out to you is that the overall impact on your portfolio with currency is actually comparably really small compared to the total returns. So you may find a 1% move in the currency, or even as much as a 5% move down in the currency, does not translate to a 5% loss in your portfolio. And that's the other thing to look at. So currency, we're fully understand about that in terms of what it means. A lot of you have actually done quite well with the currency. And on the flip side, it works pro and con if you're doing dollar cost average, all those kind of things. So we do fully take your point about the currency. Admittedly, at the moment, it's realistically only the US dollar. If you look at the Aussie dollar against the Japanese yen, the euro, the pound, even the Canadian dollar, it's actually doing better. And it's only been the last 3 or 4 months that this currency problem has become a bit of an issue for you. And in saying that, what I would point out is that it's just the impact on your overall portfolio performance over the long term is, after doing all the equations and the costings, is not enough for us to chase a hedge position because the hedging is too expensive.
I remember you saying probably about 2 years ago or longer when we did something similar to this.
Yeah.
And you bring up
probably was COVID. It was probably COVID because again the Aussie dollar was falling like a stone. It's the same point.
Just the cost of actually going out with all that, the hedging and everything, and the time you have to put into it, constantly monitoring it.
And again, there's a lot more work required from the underlying ETF to hedge, and that therefore has also seen them raise their fees over years. So although it might be 0.9 of 1% today, do not write off the fact that it will get more expensive, because the amount of work, currencies right now are moving quite quickly. It therefore is more active involvement. More active involvement means more human capital. More human capital means more cost. So we understand your point around FX. What we're trying to say to you is we are always reviewing this portfolio, but right now it still does not make sense for us to be trying to hedge and take the currency out of the equation.
There's a question here that popped up, just talking about UMAX, how it's one of the holdings. I'll just go back because it does have a smaller 3%. And what would be the reason behind that? Is that just because it mirrors already some of what's held?
Yeah, so it's mirroring what we know peers are doing. So there are, again, peers are much more active in what they are doing. They are also very attuned to what their clients want, and their client feedback tends to be quite a lot around, we want income, we want dividends. The argument that we would make about that point is that if you want that kind of material, fixed interest would do that for you. The Australian market will do that for you. We are certainly not advocating that this is the only portfolio that you should have in your portfolio and in your overall holdings. What we're saying to you is that this portfolio is there to increase your exposure to a part of the market you don't have across all asset classes: cash, fixed income, property, equities, domestic and international. And you could break down fixed interest also into domestic and international. Property, the same thing. And that's what we also do across all of those single and diversified assets. Is we're trying to give you the ability to diversify across the risk spectrum, because I just sort of saw another one come up here from Sandra. Can you give an indication of what percentage of weight of international Australian shares for the different risk profiles? And that's a great point. So again, remember, on the risk profile, or the theory that was actually designed by Nobel Prize winning Larry Markowitz around product diversification and around from portfolio diversification is the risk return profile, right? So the higher return, the higher the risk. International equities technically have a higher risk than Australian equities. Australian equities are classified as value equities. They don't move up or down anywhere near the level that you see overseas, but that also means they don't have the level of return. Pros, cons, and that's always the case. There's, that risk reward curve is exactly that principle about the payoff to risk is there. So in answer to your question, Sandra, about where it sits, is that international equities are more risky, which is why if you look at the high growth portfolio.
Yeah, look, the balance, I was going to show the balance as an example, where it's holding 26% inside that. I think it's just the whole point that we're trying to get at, to be properly invested and what a lot of Australians do is we don't give ourselves exposure to overseas markets.
Yep, and even that, I mean, the one on screen is a perfect example. A balanced portfolio is a more moderate to conservative position, and yet still has 26% to international equities. That needs to be pointed out. And as I said at the start of this presentation, the findings from the ASX is that your holdings to international equities on average, now some of you will be different to this because obviously everybody's different and everybody's individual, but on average, Australians that do have international exposure, the weightings in their portfolio is 2%. So even for a balanced portfolio, which is a conservative position, it should be more along the lines of about 20 to 25%.
Yep.
And if you go to the conservative and have a look at that as well, you still have exposure to it. You still should have some international exposure because it will give you the opportunity to grab the upside. Because when the upside comes, it will be there. So you've still got 12%, which is still 10% more than what the average person in Australia holds. So
yeah, and there's a lot of questions we get about this where people ask us, and obviously we can't say personally you should do this, but a lot of people will ask questions on these webinars like, interest rates are going up. Should I just convert my entire portfolio to cash and not miss out on that opportunity? Mm-hmm. Or I've got a balanced portfolio already. Should I add some more international equities? Again, it's very personalized. You might have specific personal reasons for that, but the whole concept is you don't want to be chopping and changing your portfolio just following the winds of the market, because market timing, I can guarantee you won't get it right. In the jobs that we worked before, a lot of analysts where even had competitions, and not all of us did very well with trying to time the market. It's going to cost you money in terms of brokerage, chopping and changing. You'll miss when the market does go back up, when we get those return to normalcy. You can miss interest rate rises, things like that. So the whole point, what we try and do is you have a goal, you understand your time frame, as Evan pointed out with, well, this is the conservative portfolio. It's saying a time frame of 2+ years. You're not locked in with any of the InvestSMART professionally managed accounts, but what we're saying is that if you chose something like this, stick with it for 2+ years. You can have various portfolios, like we've mentioned, conservative. You could put it balanced for a different goal. Put international equities in there too, if that matches your requirements. But the whole point is...
so I'm going to pick up on that because that's actually one of the questions that we got in there from Aaron, and he writes in and says, is there any benefit to owning the international equities portfolio if I already own the high growth portfolio? And that's a question we get all the time. It's a really good question to ask that. Again, what Tom's just talked about, and I'll say the same thing, it's an individual choice. So if you were to go and get the international portfolio as well, what you are doing is you're just changing your weightings to be even more high in your growth risk profile. There is nothing wrong with that. If that's what you want to do, that certainly fits in your answers. So the reason I want to highlight Aaron's question is that this is all very, very customizable. This is personal to you. How you want to invest is completely up to you. I mean, again, you could look at the conservative portfolio and go the other way. You could then hold the conservative portfolio and go and get a cash holdings that we offer you as well, or go and get the fixed interest portfolio as well to drag yourself even further towards the conservative side, whereas Aaron's talking about dragging yourself further up towards the risk profile. That's all up to you. And yes, you can do it. So that's the answer, is that yes, you can, if that's what you think you want to do.
Yeah, absolutely. Just some admin questions. All of the accounts we offer in Australian dollars only. We don't take other currencies or pay you back in different currencies. We provide comprehensive tax reporting around tax time, and that's obviously going to summarize what, whether any kind of capital gains tax has been paid, any distributions made from the ETFs that you hold, but we provide you with a report. You can actually take to your accountant or enter it yourself. I'll also quickly show, if you're someone who isn't invested with us already, you can, on any of the portfolio pages, go to, that's weird, I'll just see where that popped up. Oh, it's okay. Okay, excellent. So you can go to the InvestSMART portfolios, international equities, and you'll see here there's actually an open, sorry, just wait for it to come up. An open an account button at the top right-hand side here. But if you're already invested with us, so you might already have a number of different portfolios, when you log into your account and you decided that you either want to add some more funds, you can do it on the left-hand side and just go add funds again. And you can actually walk through and choose different portfolios to add, such as the international equities, or you can even modify your allocations. We put like a help center at the top right. So this will take you to an area where it'll walk you through and even explain other things like, what portfolio should I invest in? Or if you're already invested, you get some more information on the left-hand side here.
Is there any more questions you've got to there?
I'll
just, what I'll also do, why Tom's running through your live questions, I'm just going to close off some of the questions we had for it, because I think we've covered most of them. The only other one, they start getting a little bit more live market. So I've had one here from Bill. How long do you see the current downturn lasting? What we'd probably point out to that is that we don't try and pick the top or bottom. Not even active managers do that. And from my perspective, doing what I do, the bottom will come at a whisper. You won't actually realize what happens. So if you go back through history and you look at bear markets, which is what we're currently in, bear markets finish before you realize. It's because most people's expectations in the psychology of markets and in their mind is that it will keep getting worse, not realizing that the bottom's actually been discovered. And so that's what I think you need to remember here, is that when it happens, you probably won't realize the bottom is in. So it could be today, it could be a couple of months, it may be early in 2023. I don't know, and no one does, and that needs to be pointed out very clearly. But bear markets finish with a whisper. Bull markets finish with a crash, and that's why they're always very sharp, quite loud, and people know about them, because this smooth, consistent run. We forget that till 2019, the longest bull market in history was seen in the US, which was 11 years. Here in Australia, we had 9.5 years of bull market runs. And bear markets also tend to be short, so they're not as long. They tend to be no more than about 9 months. They are, up to about 23% on average. So again, answering Bill's question, A, I don't know. B, it'll end before you realize. History shows that in the US, for example, bear markets tend to finish when they finally declare a recession. Now, we all know at the moment that's all you're hearing about is when does the US have a recession. There's a point and an argument to be made that maybe that's the trigger point, because markets are trying to think, okay, can it get any worse? Probably not. And what does the next 12 months from here look like? It'll probably be showing signs that, economies will have to start growing again. People will have to start thinking about how to actually get in a better position. So 12 months from now, things will probably be better. And that's why it's really weird and counterintuitive to some people that when a recession happens, it's actually the time that normally is a signal of the bottom of a bear market. So Bill, that's the best way I can answer that. Again, what I would say to you is that just be aware, we are in a volatile time. It is likely intraday, intra-week, intra-month to be very, very up and down, and can play with your mind. There's no doubt about that. The loss aversion that comes with investing is very, very strong, and that is completely fine, and so you should be, and we get that. But the longer term return, as I showed you, over 30 years, with those international markets, you've got the Asian financial crisis in there, the global financial crisis, the Euro crisis, COVID, all these major events are inside of it, and it's still averaging 10% per annum.
You've been fairly across this recently, haven't you? Because you've just written a book about it.
I have written a book, and I'm very excited. I'm sure for InvestSMART I'll do a webinar about it. But yes, I've done a book. It's due out on the 11th of October. It's called Mind Over Money. It's been quite a labor of love. I've really, really enjoyed it. I hope if you do get it that you love it too. It's all around behavior and investment behavior. I think it's the most important thing to think about when you're investing, is that we consider about the economics, we consider and talk about the FX, we consider and talk about how to invest in certain different ways, but you are you. The individual that you are is being created by your experiences and your time. And I talk about this in the book, and I want to talk about, it talks about this as well, is that the questions here, you can tell, they are behavior questions. You are asking this because it's personal to you. Do I need this weighting? Do I want this scenario? And why I wrote the book was to get you to say, okay, who am I as an investor? Who am I with money? What do I want from money? What is money to me? Those are the questions you should be asking yourself. The book asks you that, and it might help you answer the question about being invested in the international equities portfolio, to show that actually I do have time, I do need to do this. It's going to be beneficial for my longer term wealth.
Absolutely. And I know I've definitely asked you a lot of those questions in the period I've known you, but we also have the boot camp that is a big part talking about investor psychology. And when you invest in the international equities portfolio, you'll get 3 complimentary coupons. So you can use it yourself or give it to other people. There's a question here just from Damien talking about what happens to the dividends in the portfolios if you don't want to have the dividend reinvestment plan. So part of what we offer is that we manage your portfolio, and if you choose to have it reinvested, which is the default, we automatically put it back into the portfolio. So we don't just concentrate though on one of the ETFs in that portfolio. We'll actually spread it across and make sure it's balanced and stays within those percentages. Otherwise, if you're someone who wants to have the income paid out, you can turn on the income paying out settings, and that's all done from the online platform.
We're probably getting close to the end of the presentation. Are there any more questions that you have? What we'll also do is that this is recorded. We'll also upload this to the website so you can rewatch whatever you need. If you've got questions after the presentation, please send them in. invest@investsmart.com.au. We are here to answer all those questions and beyond. And we'll be able to give you any other additional material that you need. So if there are any further questions, please just send them in now. Otherwise, we'll have to wrap up because we are a little bit over your time. I do understand that.
Yep, absolutely. And you can always ask us, as Evans mentioned, there's even a live chat here at the bottom right-hand side of the page where one of us will pop up. There's my face at the moment, it looks like, so very lucky. But yeah, we'll definitely do our best we'll put the video up soon and answer any other questions that might come through. But apart from that, I think
we're done. It's been great to sit next to you, Tom.
It's been very good. I just have to, make sure that wear my mask on the way home.
Yeah. No. And guys, thank you so much for watching. As I said, it's been an absolute pleasure to present today. We look forward to doing it again, and hopefully your investment journey is a pleasant one.
And if you've got any tips about, if you want us to talk about specific topics, definitely send them through. You can send it to invest@investsmart.com.au. But Evan, as always, thank you.
Thanks, Tom. Have a great day, guys.
See you later.